Payment of cash dividends. Here's the facts. December 1st, 2012, Media General declares a 50-cent per share cash dividend on 100,000 shares of $10 par value common stock. Now there's 3 dates that are relevant when you're paying cash dividends. And the first date is the declaration date, which in this case is 12/1/12. So the journal entry on that day is going to be debit cash dividends for 100,000 shares times 50 cents, which is 50,000. Okay. Now this account, cash dividends, is an equity account, and it basically reduces retained earnings, and it will get closed out to retained earnings at the end of the period. And for that reason, some companies will just debit retained earnings right off the bat instead of debiting cash dividends and closing that out to retained earnings. And this is the date that the company becomes legally obligated to pay the dividends. So it's a liability, dividends payable for 50,000. Now the next date that we're going to be looking at is the date of record. And what that is when companies declare dividends, they have to have a cutoff point from which to say whoever owns the stock at the close of business on such and such a day, and in our case we'll say the date of record is December 22nd. So they're saying, because stock is trading hands all the time. So between the 1st and the 22nd, stock is going to be trading hands, but they're basically saying we're going to write the checks, the dividend checks, to whoever owns the stock on December 22nd. Okay? And there is no journal entry required because there's nothing happening except now they know who they're supposed to write the check to. Okay. The last date is the payment date. And that's when they're actually going to write the check, the dividend checks, and send them out. And let's say that in this case, is January 20th of 2013. So this liability up here, dividends payable, will be debited for 50,000, and they'll credit cash for 50,000. There's cases when you have preferred and common stock that you have to allocate the cash dividend between the two. So here are the facts. At 12/31/2012, IBR Inc. has 1,000 shares of 8% $100 par value cumulative preferred stock. And they also have 50,000 shares of $10 par value common stock outstanding. The first thing that we want to do is find out what are the required dividends. If IBR is going to pay dividends to preferred stock, how much is that going to be? So the preferred stock dividends are based on this formula. You take the par value, which in this case is $100, times the dividend percentage, which is 8%. So that's $8 a share, and you times it by the number of shares that they have outstanding, which is 1,000. So the preferred dividends are going to be 8,000. That's every single year. And this stock is cumulative, which means if we don't pay $8,000 one year, it's going to be accrued and has to be paid the next time dividends are declared, and has to be paid before common gets anything. So let's say at 12/31/12, the directors declare a $6,000 cash dividend. Now, why wouldn't they declare a bigger cash dividend? Well, they probably didn't have enough cash, and you also have to have the amount in retained earnings. So that was all they could afford, which means all of that is going to go to the preferred stock. So the journal entry is going to be cash dividends for $6,000 and credit dividends payable. And this is the same journal entry that you had when you pay a cash dividend to common or preferred. It's just cash dividends. But we have to keep track that now we have dividends in arrears of $2 a share for the preferred stock. Now at the end of the next year, it's been a better year, and 12/31/13 IBR declares a $50,000 cash dividend. So now let's see who gets what. We're going to list preferred and common and total. So preferred is first going to get its dividends in arrears. And that was $2,000 because we owed him $8 and we only paid him $6. So it gets its $2,000. And then preferred stock is going to get its current $8,000. Okay, so that right there adds up to, so we got 2,000, 8,000, so 10,000. If 50,000 was declared, then common gets the rest, the 40,000. So the total that would be received is preferred gets 10,000 and common gets 40,000. We'll put this over here. I don't know, this total column is maybe a little meaningless. But anyway, that's how you divide it up. So whenever you're doing problems, you have to read carefully to find out two things. One, is preferred cumulative or not? If it's not cumulative, then whatever dividends they miss out on, they don't get. And if it is cumulative, read carefully to find out if it's got any years in arrears. Might be 1, 2, 3 years in arrears. In this case, it wasn't even a full year in arrears because we paid 6 and we owed them 8. So you just have to be mindful and read carefully.